Welcome to Odds and Ends with Dave Singh and Rob Friesen. This is a StockOdds podcast to help you get ready for the week and help us get bearings on how we're going to trade for the weeks.
So are you feeling Rob? Better? Are you feeling better out there? What's going on?
I'm better. My weather's getting better. It's warmer. My voice is coming back, so all good.
Okay. Well, not all good with the world completely, but in your corner, it's all right.
In Southern California,
for us great. On the seasonality front here.
Yeah, I mean, so we're approaching the final bit of February here. It's the last 5 trading days of the month, 4 days this week, and then 1 day come next week. But we have such a big macro theme going on, the Russia-Ukraine situation. But let's first look at what would typically happen towards the end of February, and then you can layer on the macro and the geopolitical risks. But the last 5 trading days of the month, there are some stocks that are expected to do better typically, and they're kind of the risk-on stuff. And even some of the meme stocks, GameStop, CRISPR, ENPH, Square. So those are some of the risk-on high beta plays that would typically play out. And some of the things that would typically sell off are gold. So GDXJ, GDX, XOP, some of the ARK funds. So that would be a typical seasonality for the last 5 days of February. And then also some of the sectors within, like relative performance. Small caps would do worse than the spider. The Qs, Nasdaq stuff should do slightly worse than the spider as well. And things like chips might do slightly better. But it's nothing clear-cut. It's not like certain sectors are expected to vastly outperform the index. So it's kind of a mixed result there, but a little bit of a high beta play risk on or sell-off in gold. And that's kind of counter to what we're seeing right now in the past couple of days and set up for this week, because this Russia-Ukraine thing is really overriding. So how do you see over from your perch on the geopolitical risk, Rob?
Well, I mean, we've had this before. It doesn't happen all the time, but we do have where macro themes override seasonality. One example was pretty much from September until November. That was supposed to be a fairly weak season for oil. Historically, that's not when oil performs its best. But because of the demand shock that started to come back in after the lockdowns and stuff globally, and a lot of production was taken offline, and then supply chain disruption and so on. Then we had other things like the pipeline hack, and it just storms and things. Sometimes you get like perfect storms where there's a lot of contributing factors, but right now, of course, the macro is geopolitical and war. And so, oil is going to respond to that naturally. Gold is going to respond. So there was some, banter about gold not performing super well as we're facing interest rate hikes. But they have been accumulating it even before this event. And so I think there's just the uncertainty and the fact that Bitcoin has been struggling to show itself as a flight to quality type thing, hedging risk. It's shown up as more of a correlated risky asset with so many other risky assets. So there's no flight to quality there per se. Maybe tomorrow's different. I'll take a look. I haven't even checked to see how things are going in the crypto space at the moment, but well, let's just do a quick check. Well, it looks like Bitcoin's off 7.26% as we speak. Ethereum is also down 7.83%. So they're taking it on the chin just as well. But back to our futures. So let me just run through where we're at right now. So the Dow futures are off 513, so 1.51%. The S&P 500 is off 76 points, 1.76%. Nasdaq is a little bit more interesting than the other two, only because they're coming up to their lows from January, but the Nasdaq 100, which is now down 2.45% or 343 points, is actually below its January low. So we're really into a big air pocket here. Russell is still quite a bit above its January low, and that is down 1.9% or 38 points. When looking at the Nikkei, that's coming up to its support level from January, so it's not quite to its low. The DAX, on the other hand, is into a massive air pocket, almost 1 year in the making here. So we've broken down. So I think there would be, because of the support level we were on before this event, I think there's some DAX traders that would be caught on that. And then we have volatility spiking 5.69%. We're back up just under 30 now. So definitely, a cause for concern. If we go to the metals, we do see gold up 11.6 for 0.61%. Silver's up 0.72. Platinum 1.13. When we go to the currencies, we see the US dollar up slightly, 0.17. What was interesting for me is on Friday, looking at all the news and kind of just thinking through things, and I went and said to my wife, I said, I would wager that Putin will, make a move into the Ukraine in whatever capacity. He would probably move in after the Olympics, after the ceremony, or right up to the end of President's Day, which would be kind of ironic that it's moving in on President's Day just to poke at Biden a little bit. But anyway, so I went on Friday then talking to her and voicing my opinion. I went and did something about it as well. I took gold long over the weekend and some defense contractor, and also shorted the Nasdaq 100, the Russell, and the S&P. So I've pretty much short all those guys. So it should be a nice start to the day tomorrow. We'll see how things play out. And there may be a bounce. Who knows?
But I have a question. This is not surprising. So, like the last 2 weeks, the market has had a chance to digest the possibility of invasion, right? So it's been going on for 2 weeks now. We've seen some sell-off in advance of that, and today is like the most closest to that. But has it already digested that news? And we're
no. If I look at it this way, I think most people thought that the Ukraine was a little bit of kind of trying to get some extra benefit out of this, maybe crying wolf a little bit. And I think there was enough sort of banter that the U.S. intelligence wasn't super reliable on this subject, So I think there was enough banter, enough talking heads that kind of put forward that there probably wasn't going to be an invasion. It was all more, sort of staged for putting pressure, on this whole NATO thing, so that Ukraine wouldn't become a part of NATO and all that, right? But when you push yourself back from all that and you just think about it and go, someone that moves that amount of troops completely surrounding, all the available border, and then you already have your sort of insurgents, in part of the Ukraine anyway. It just makes sense that you wouldn't go to all that trouble unless you were willing to back it up with an actual progressive entry into the Ukraine. So it doesn't surprise me at all. I think, I do think some people are surprised, but I just I don't know. I don't know. I've been in this business a long time. I've seen Putin do a few things through the years. So, you know, when I started trading, it was just after the Afghanistan thing, right? So, yeah. So I've seen a lot of things. But anyway, so we have to expect that even if we get a bounce back on the market, if this thing is not retracted, meaning that they don't turn all those troops around and can go back out and say, okay, you know, we agree to some negotiations. We're going to be, you know, bouncing around, and the markets have potential to go lower. You know, it may be that oil continues to move higher because we're in a backwardation of oil. Do you remember the contango we had in April of 2020? You remember April? Remember the May contract? We went negative, right?
Yeah, it went negative the first time.
Yeah, well, that was contango. We had such a massive problem there. Now we've got the opposite, which is backwardation. So I'm kind of curious whether, and it's the most extreme it's been in a long time. So I'm wondering if we're not going to get a super spike. So like I think the upward targets might be 150 a barrel, but you know, what if just like the negative shocked and we went to you know, minus what, 35 a barrel or whatever it was. I mean, what if we had a super spike that went up to 200 or 250?
Like a reverse flash crash.
You know, so that wouldn't surprise me at all either. I mean, you get old enough, nothing surprises you anymore. But so yeah, so I wouldn't tackle, you know, shorts on oil. I wouldn't tackle shorts on gold as of yet anyway. Kind of let those play out. So, you know, when you have something that's supposed to be seasonal and gold's supposed to be kind of backing off, and you get a catalyst that comes along to override that, then you know, you really have to allow it to breathe and not argue with it, right? So
what are some of the sectors though, given, I mean, typically like utilities and staples would be things you grab.
Well, you'd want to be more defensive. So like for example, if the market's down already 500 points on the Dow futures, then, you know, probably most sectors and industries are going to be red tomorrow, other than potentially the gold or some of the industrials like the defense contractors, and, you know, possibly well, I mean, I think utilities would be more defensive, but they still might be down. You know what I mean? If you're trying to do baskets, you want to have long and short ideas, and the whole goal is to have your shorts move down more than your longs. So what kind of longs do you need to have in there? So things that are defensive. So staples,
commodities,
some commodity related consumer staples. You would want utilities potentially, and the things that are going to be risky are things that are, again, very sensitive to a risk off approach. They're speculative. You know, the prospects for financing are diminishing in this type of situation with rising interest rates, you know, taper. Now we've got, you know, global risk where people will just pull back and not take much risk, right? Like, why would you want to stick your neck out when things are uncertain? You know, why wouldn't you just go to cash? So if they're not going to be able to pull those investors back in yet, then there's more room on the downside. You know, China's certainly going to be facing this. You got to be cautious about, you know, making sure you know what you're doing with the China stocks, because we've still got a massive real estate problem there, and we also have still the onslaught against fintech and technology there. So, like, for example, an investigation into all the parties that are related to the Ant thing with Jack Ma. You know, it's not over in China as far as the downside, and that's going to, you know, play into things as well. So if you're moving to cash, it's like, when do you want to redeploy that cash? Like, what does the world look like for you to be able to redeploy it?
Mhm.
Now, we could still have bad news, and you could redeploy. But like, we just had this Russian invasion of Ukraine, so that's actually happening now, right? It was, you know, we were already nervous about it, but it hadn't happened. Now it's happened, so I think it has to work itself out here. How much does the U.S. get involved? I don't know. How much does, you know, the Ukraine, you know, supporters? I mean, because there's a lot of pro-West, you know, political situation in the Ukraine. I mean, so who's going to come to their support? You know, we don't know how this is going to play out, right? We just don't, you know. So I'm going to be looking at, for tomorrow morning, and possibly for this whole week, which is a compressed week, as we know. So there's a lot going to happen in 4 days, and then the last trading day of the month is a Monday. And a lot of the things are, you know, not supposed to be performing that well in February seasonality anyway. Like, when I ask you what's the weakest groups, what's the strongest groups, what can you tell me? The weakest groups.
Yeah, IWM was, so the small caps were weak, but even the S&P 500 was supposed to be weak. So most sectors were close to that. Some were worse. I mean, like technology was a little bit worse.
That's a situation where we already had not a robust environment for the end of February seasonality, okay, with our major markets, and now we're adding this to that, right? Yeah. So I expect that, you know, we don't really have some great arguments to bounce up and have a risk on appetite right now. You know, it's going to be stay on the sidelines, stay in cash, you know, or move defensive or hedge, you know, things like that. So I'd like to, you know, be long the commodities, long gold and oil. And these are obvious trades, obviously. It's obvious, obviously. You know, and you know what? You can make money from the obvious, because things can trend a lot farther than you expect. I think you were mentioning to me the other day, right? It's like you've seen a lot of persistence of these trends. Like,
yeah, I've been watching a lot of pairs intraday, and come midday, things that are out multiple standard deviations. These are pairs within the same industry, same sector. But once they're trending out, they just continue that way throughout the entire day. They don't really mean revert. So this persistence of trend, open to close, can be exploited, I guess.
Right. And also be aware there's a fair amount of earnings this week. I think we have like Home Depot on Wednesday, I believe. Just check. But there's quite a few earnings this week. We've got before the open on Tuesday is Home Depot, so that's already tomorrow. We got, after the close, we have Agilent, Toll Brothers, Palo Alto Networks, Range Resources, Mosaic, Caesars. Before the open, we have Hecla, Exelon, Home Depot. Wednesday, you've got Energy, Tiki, Booking.com after the market, Chesapeake. But there's a lot of earnings this week, and they're not as predominant as some of the ones that come early in the earnings season, you know, such as the brokers and the banks and, you know, some of your big techs. We're already past that, but there's still a lot of others to report. So just keep that in mind. Check so you know what's going on. Yeah, anyway, so the main thing is with dealing with these type of events, like, you know, if you are unsure about how to be positioned in a sector or an industry, then you can just, avoid it, right? And go into the ones that are going to be more forgiving. Like there's a couple utility stocks that have earnings this week, but other than that, it could be a good, place to be kind of either long utilities or long and short some, kind of a good hedging strategy to be long and short in utilities. Same thing with consumer staples. Same thing probably with some industrials. But again, some industries in that sector are going to be, more desirable than others, right? Like I said, defense contractors, I probably would let them breathe. I wouldn't want to necessarily be short. So when you take your odds from StockOdds and go in and do this, again, the safest thing can be to take some long ideas and short ideas within electric utilities, long ideas and short ideas within gas utilities, long and short, some telecommunication companies, long and short, some consumer staples, some food stuffs, things like that, right? Financials probably are okay. Let's just take a look at what's happening in the bond world here before we go.
Yeah, the 10-year was down like 1.9, just slightly lower.
Yeah, we've had quite a strong move up here after. So we gapped up at around 6 p.m. So we're holding up on the 30-year bond is up 0.88%, 10-year notes up 0.44, 5-year 0.21. So definitely a response there to the upside on the bonds. All right, well, let's call it a night here and get ready for tomorrow.
Should be an interesting week.
It's going to be interesting for sure. It's when volatility increases, just make sure that if you're fishing for things like you want to put a spread on, remember what's the hard side. Do that first, and you can fish like more conservatively, like you don't have to be so aggressive because volatility is high. So let me give you an example. If the VIX is at 15, I might be 3 to 5 cents away from the NBBO trying to pick up maybe an outlier. But if the VIX is at 20, I might be 7 to 13 cents. If the VIX is at 25, I might be anywhere from 17 to 27 cents. If the VIX is at 30, I might be even sitting at 30 or 40 cents away. I had a number of times last week where go to do a Q's trade, QQQ, Nasdaq 100, and suddenly it moves, 30, 40 cents, 50 cents one time. Literally, I had just bought it and it moved in my favor 50 cents. I mean, for a big ETF to move like that is, kind of astounding. Normally you would have it move slowly, 5 cents at a time kind of thing up there. But so this is a factor of volatility. You have to give it more breathing room, pick your spots better, let things, go both ways, right? Because, we could be down, we could have a day down tomorrow where maybe we open and we sell off further and we're down another 1,100 points and then you reverse again, right? You can have that. So don't get stubborn, allow more room. Remember, things swing both ways when you have volatility, and think about the type of stocks that are riskier, bad fundamentals. Not a time to be picking them up on a discount when we're in these kind of environments. Rather, you would go, hey, if a good defensive group to be in is gapping down in sympathy with the market, that's what I want to buy. I want to buy the stuff that is good to own on a day like tomorrow. I want to buy it as it gaps down with the market, right? So think about that. This, your high quality wish list, your defensive names, you know, lots to choose from there. But you know, just think about when the market gaps down, not all things gap down with the equal odds of retracing. If you're in a company that has a P multiple of like 5,000 and, you know, it's got all kinds of problems, tomorrow isn't the day to be buying it at the open, right? But if a great utility stock that's very robust, low PE, has, you know, great earnings, great dividend, things like that, it gaps down, yeah, I would definitely take it. But now the thing is, you still have to hedge because it could still slide a little bit more. It just won't slide as much as the other things. And that's the key, relative performance arbitrage. Okay?
Good thoughts. All right. Good luck.
All right, my friend. Good luck.
Thanks. Bye-bye.